Let's just get the shutdown out of the way. Is it noise or is it significant?
I think it's noise. Historically, it's been noise. In the future, it'll probably be more frequent, but also noise. And I think even if you had a prolonged bout of turmoil politically based on this, I think markets are forward-looking enough to look through it.
Right. Forward-looking enough to start paying attention to a debt deadline in March, right?
Yes.
That's when things get a little more serious.
Right. I think the trade deadline in March is something that's really weighing on investors right now. And we just did our quarterly investor survey, and what we found is that most investors, on the equity side at least, don't think we're going to have a trade deal with China by then.
Most do not.
Do not. There is doubt that we are actually going to get that out of the way. So I think that's one thing that's clearly weighing on markets right now.
That's clear. I mean, in our view, you do get some relief from trade. You do get some relief from the Fed. You just don't get them yet, right? And the Fed meeting this week was a good example of that. An attempt at a dovish hike didn't quite succeed. The trade situation is a matter of balance. It's a matter of the political incentives to strike a deal, and there aren't many, actually, regardless of what side of the aisle you sit on, and the economic costs of the trade war, which are escalating into the beginning of next year. So if you do go from 10 to 25% on 200 billion, if you do put on tariffs on the remaining 267, our assessment would be that raises the economic costs to come into balance with the political benefits, and at that point, I think they strike a deal.
So is the market signaling a recession, Lori?
Well, I think we're at an important crossroads right now. With the damage we did yesterday and the last few weeks, we've basically put in the drops that we saw in 2015, 2016, and 2010. We haven't quite done the 2011 drop just yet. If you get a few more percent, then we'll be right there. That drop was 19%. I think, interestingly, the stat I've been talking a lot about the past few weeks is that if we fell another 10%, we would actually be pricing in the median recession. So I think if it does get too much worse from here, the market is on its way to doing that, regardless of what the economics community is telling us.
I always like to remind viewers of your bearish call on tech way before October when you were getting laughed at essentially on some of your bearish tech calls. Do you feel differently now or not?
It's interesting. I've been marketing a lot in December, and I'm finally to a point where people are not fighting with me on technology, and instead we're talking about what are the last shoes that might need to drop within that sector. It's interesting. We haven't changed our call. We think it's still too early to jump back in. Our valuation model, unbelievably, is still just hovering right around neutral from being unbelievably overvalued at mid-year. So we do think there is more pain to come.
What are the shoes? What are the shoes to drop before you actually would say, okay?
Well, I would say a couple things. If you look at it industry by industry, what we saw in 3Q rather was that the hedge fund community piled out of the semi stocks. They got out of the tech hardware space, but they really ratcheted up their exposure to software and IT services, which were supposed to be these areas that were insulated from the trade war and secular growers. So I see sort of two risks going forward. One, we're hearing a lot of companies, or we're seeing a lot of survey data that's saying that CEO confidence has come in, CapEx expectations have come in. Well, guess what? The tech sector tends to trade in line with capital expenditure activity. So we do think that the software space could see a little bit of pressure if IT spending expectations get cut back. So that's one thing to watch for in this difficult environment we're in. The other thing is, let's say we do get a trade war deal or trade deal with China. I think that the hedge funds will reverse that trade and pull out of the crowded and expensive IT services and software names and go back in and buy semis. So I can see a couple ways we could get there.
Finally, I wanted to ask you, Ben, about cash, because all week long it's been Tepper, Goldman, PIMCO today saying basically pile up going into 19. Do you share it?
I think there are different ways to hedge sort of end-of-cycle risks. So what you want to be holding for that end-of-cycle growth shock is actually duration, so something like treasuries. And you've seen over the past month or so a great example. Worries about the sustainability of this expansion, and bond yields dropped, and that's exactly the hedge you'd want in a balanced portfolio. So I think there's a place for cash. The real return is positive. That's good news for the first time in a long time. But that's more of a hedge for inflation shocks where we see less need for that over the course of the entire late portion of this cycle.
I hate to put you in opposition to the chairman and CEO of your company, but I'm still waiting for those 4% bond yields.
Yes.
Yeah, so he didn't mention the time frame.
And he's a fair-minded guy. He's a fair-minded guy.
So
he likes
give
argument.
A number or a time, but not both.